If I asked you how you were going to create income in retirement, what would your answer be? It's probably a combination of things, but mainly most people are going to say their retirement savings and Social Security income. It's probably going to be a combination of both of those. Now, if I asked you about what are you going to do for health insurance? Well, depending on when you retire and your age, before 65, you're probably paying for it out of pocket. 65 and older, using Medicare. Notice anything about those answers? Both involve a federal benefit. One of the things that I've noticed is that people don't understand how Social Security income is taxed and how Medicare premiums are determined. So today, that's what I want to cover. Let's jump right in. For many retirees, their Social Security income feels like a safety net or their security blanket, but it's not automatically tax-free. The formula that the IRS uses to determine how much of your Social Security income is taxable is called Provisional Income, and it's calculated as follows. Your adjusted gross income plus any tax-exempt interest for municipal bonds plus 50% of your Social Security income benefit. Now, that number determines how much of your benefit becomes taxable. Here's what surprises most people. These brackets are highly compressed, and they are not indexed for inflation. And so to give you an example for the 2026 threshold is if you're filing single and you make over $34,000 of provisional income, 85% of your Social Security income is taxable. If you're married filing jointly and you both make over $44,000 of provisional income, up to 85% of y'all's benefit, it will be taxable. Do you notice how low those numbers are? It doesn't take much income from a pension, IRA withdrawal, time work, etc., to push you into the 85% range. Now, there are strategies we can use to reduce the impact, but with thresholds this low, it takes intentional planning and some time. Now, let's talk about IRMAA, or IRMAA. IRMAA stands for Income Related Monthly Adjustment Amount. IRMAA determines what you pay for Medicare Part B and Part D. And unlike Social Security taxation, this isn't about how much of something is taxed. This is about your actual monthly premium. And IRMAA is based off of your modified adjusted gross income, and it uses a 2-year look back. So what you earn in 2024 determines what you pay in 2026. That delayed impact catches many people off guard. The biggest mistake I've seen around this is when somebody completes a large Roth conversion without considering the IRMAA consequences. They reduce future taxes, but accidentally spike Medicare premiums 2 years later. And once you trigger a high IRMAA bracket, the increase can be substantial. This is one of those, oh no, what have I done moments. Retirement tax planning isn't just about how much you have. It's about managing provisional income, avoiding unnecessary IRMAA spikes, planning for the widow or widower tax shift, and being diversified across time, type, and tax. Now, if you're in retirement or approaching retirement, you want to make sure you're not stepping on any tax landmines. I'd be glad to help. I'll walk you through it. You can also find the provisional tax brackets on my tax reference guide. Next week, we're shifting gears. We're getting ready for the Kentucky Derby, the fastest 2 minutes in sports and what it teaches us about investing. We'll see you then.